Well, welcome to our HIROC clients and other listeners on this rather gray Tuesday afternoon in Toronto. And thanks for taking the time to tune in to our weekly webinar where we're going to talk about what we see happening in the global economy, financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategy. So sit back, relax, perhaps grab a glass of wine. We're recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined on the call by my partner and colleague, Paul Tepsich, the founder of HIROC. Our financial planner, Bianca Tomlinson, is also on the call. We will have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we invite you to feel free to ask questions. If you're a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the About HIROC tab. Well, what's happened since our last webinar? Let's check into the top Google searches in Canada over the last week. Well, Wednesday it was Adele's 25 album, which sold about 3.4 million copies in its first week in the U.S. The NFL was most on the mind of searchers on Thursday, U.S. Thanksgiving Day. Robert L. Deere was named as the gunman who stormed a Colorado Springs Planned Parenthood clinic on Friday. Tyson Fury beat Vladimir Klitschko in a unanimous decision Saturday and took the heavyweight titles. In boxing, also on Saturday, the UBC Thunderbirds won the Vanier Cup, and Sunday was the Grey Cup. Now, Google celebrated Lucy Maud Montgomery on Monday with a doodle search, and today it was the elf on a shelf. Well, Google searchers continue to show no interest in financial markets, so let us help fill in what's happened since last Tuesday and get a sense of what is yet to come and what we're doing with our models to get the best risk-adjusted returns. There's lots to cover this week. U.S. and Canadian bond markets were higher on the week as further economic weakness increased bond buying. Some tax loss selling continued to drive preferred share markets lower. Canada and U.S. bond yields were down by 11 and 9 basis points respectively in the 10-year area, and the spread between them widened to approximately 65 basis points as prospects for economic growth in both countries weakened. Well, the World Equity Index was higher by about 0.5% over the last week. This time, and over the year, up by about 1.5%. Germany's Xetra DAX index was the best performer at plus 3%. China's Shanghai Composite was weakest performer, down about 4.33%. Well, technically speaking, the benchmark world index is once again testing selling resistance at the downtrend line from last May, just below 58.5. Now, a break higher would invite more buying as we head into year-end and may just bring about the Santa Claus rally. On the other hand, if selling pressure tests and breaks the uptrend from the August lows at or about 56.5, that will likely bring more selling and drive prices to test the September and August lows. Now, the catalyst for more buying may come from greater than expected stimulus from the European Central Bank later this week, and or data that might keep the U.S. Federal Reserve from raising rates in December, because in the short term anyway, stock markets like economic weakness because it means lower interest rates for longer. Now, common sense might suggest that economic weakness is not good for corporate earnings and that stocks are already too expensive, but common sense does not often win in the short term. In the short term, logic does not necessarily win the argument. But our discipline dictates that we refrain from buying expensive assets, and we'll talk about this more a little later in the webinar. Well, oil was slightly lower on the week, and as was the Bloomberg Commodity Index, which is continuing to test multi-year lows. Volatility was little changed, just sitting just below its long-term averages. Well, as the World Equity Index is comprised of about 52% of U.S. companies, we keep a close eye on what is happening in the U.S. economy. While we wait for the U.S. Fed to meet on December 15 and 16 and announce their next monetary policy moves, we closely watch the economic data that might give financial markets some indication of what direction they may take. Fed governors have been, Fed governors have been quite vocal in recent speeches, preparing the markets for a likely liftoff of 0.25%. Bond markets have built in a 70% chance of this happening. However, disappointing news from the manufacturing sector this morning may give the Fed pause as the widely watched ISM index dropped below 50 for November, which indicates a contraction in this component of the economy and will weigh on the potential for future economic growth. This was not expected. This does come on the back of building inventories, and as we have discussed for the last few weeks, without sales to reduce those inventories, factories need to reduce production until those inventories are reduced, and this results in slower economic activity in the interim. Paul, did you want to talk a little bit about the GDP Now forecast? Perhaps Paul is having some technical difficulties. So I can expand on this just a little bit, but basically what this is the forecast from the Atlanta Fed, which tries to take all of the economic data and forecast where expectations for economic growth are going. And as you can see, this more recent forecasting tool has started to point significantly lower to lower GDP growth in the U.S. So we're going to continue to monitor that, but definitely it's something the Federal Reserve may in fact be taking a considerable interest in going forward. So whether it influences their upcoming decisions or not remains to be seen, but certainly it is something worth monitoring. Well, on the sales side of the equation is the consumer. A recurring theme for our weekly discussions has been the changing demographics, which is important for the U.S. economy because the consumer is responsible for close to 70% of U.S. economic activity. And the consumer right now is just not spending. Last week we saw the most recent data on consumer spending, and the trend from the beginning of 2015 continued to show less consumer activity. As we often have said, uncertainty in the global economy reduces confidence and consumers postpone their economic decisions. Now, while U.S. consumers have been paying less for gas and other energy goods, instead of spending the difference, they've been saving. Our thesis has been that baby boomers are saving more for retirement and spending less, and the next largest cohort, the millennials, who are in the age group somewhere between 25 and 35, have less money to spend. There are longer-term implications for the U.S. economy here, but at the moment it is why the recovery since 2008 has not been robust, and economic growth continues to underperform and may continue to underperform going forward. Early signs of the holiday shopping period showed brick and mortar stores face difficulties. A National Retail Federation survey on Sunday showed more people shopped online than in-store during the Thanksgiving weekend. The S&P's Consumer Discretionary Company Index lost 0.5% on the market yesterday. Online sales were reported this morning at slightly less than expected levels. Well, it's not just the consumer either. Companies have been reluctant to step up spending on the basic building blocks of the economy, such as machines, computers, and new buildings. Instead, they've been spending money on share buybacks, as we've discussed in previous webinars. The broadest measure of U.S. business investment advanced 2.2% from a year earlier in the third quarter, a report from the U.S. Commerce Department said last week, making one of the worst performances of the six-year-old economic expansion. Other measures show an even gloomier picture. A gauge of capital expenditures, orders for non-defense capital goods, excluding aircraft, declined 3.8% through the first 10 months of the year compared to the same period in 2014. According to government estimates, weak investment restrains economic output. One key reason the economy has struggled to grow faster than 2% in recent years. The weakness also saps the economy's future potential. Capital expenditures are an important ingredient in improving employee productivity, which has grown at a very anemic pace in recent years, but is certainly critical to workers' wages and ultimately corporate profits. So the Fed wants to raise interest rates, but the U.S. economy is showing signals that are far from robust, as we saw also in the GDP Now chart. Now, on a global scale, populations in the developed countries are also shifting. According to research from the Wall Street Journal, next year the world's advanced economies will reach a critical milestone. For the first time since 1950, their combined working age population will decline, according to United Nations projections, and by 2050 it will shrink by 5%. The ranks of workers will also fall in key emerging markets such as China and Russia. At the same time, the share of these countries' population over 65 will skyrocket. Now, this reflects two long-established trends: lengthening lifespans and declining fertility. Yet many of the economic consequences are now becoming apparent. Simply put, economies are running out of workers, customers, or both. In either case, economic growth suffers. As a population ages, what people buy also changes, shifting more demand toward services such as healthcare and away from durable goods such as automobiles. Well, the World Equity Index contains about 16% of euro area companies, and while consumer confidence has been improving since 2012, it still remains in negative territory in the euro area. And business confidence has not been able to show any significant growth. And that's why the European Central Bank is expected to announce plans to further add monetary stimulus later this week. Inflation remains well below targets because the economy is underperforming. It all comes down to confidence, and the ECB is hoping that more stimulus will help propel confidence in the euro area economy. Thus far, however, the stimulus to date has had only a minimal impact, and there are many who are not yet convinced. Although euro area unemployment has continued to decline, as we saw from the data that was released this morning. Well, Japanese companies represent 8% of the World Equity Index. Japanese economy slipped into recession with negative growth in the second and third quarters of 2015. However, last week, the seasonally adjusted jobless rate in Japan fell unexpectedly to 3.1% in October, down from 3.4% in the previous 2 months and beating market expectations. It was the lowest value since July of 1995, as the number of unemployed declined sharply while employment rose. Meanwhile, consumer prices in Japan rose by 0.3% year over year in October, after showing no growth in the previous month and beating market expectations. It was the highest figure in 4 months, as food costs rose further while prices of fuel dropped at a slower pace. When excluding the effect of energy and fresh food costs, a new indicator published by the Bank of Japan showed consumer prices rose by 1.2% year over year in October. Well, companies in the UK represent 7% of the Global Equity Index, and the latest UK third quarter GDP data was announced on Friday, showing annualized growth of 2.3%, slightly lower than expectations, but the trend has also been lower. With this trending lower growth and inflation below target, the Bank of England has backed off of their desire to raise interest rates for the time being, suggesting that now it was in no rush to do so. Chinese companies represent 2.5% of the World Equity Index. The Chinese economy continues to show signs of slowing growth, and manufacturing has slumped to a 3-year low. Interestingly, yesterday the International Monetary Fund announced that it is adding the Chinese yuan to the basket of elite currencies comprising its lending reserve, marking a milestone in the country's ascendancy as a global economic power. The IMF's move, which won't become effective until late next year, could help accelerate a mild pickup in international demand for the yuan. It confers a measure of international legitimacy to China's currency as the government starts to liberalize its rigidly controlled exchange rate and financial system. In Canada, where companies represent 3% of the world index, the latest third quarter GDP data released this morning showed a recovery from the first 2 quarters of negative growth. The export economy was the key driver on the back of a weaker Canadian dollar, but the domestic economy continued to struggle. Now, the monthly data for September showed a sharp slowing of economic activity, but a good portion of this can be attributed to an August fire at the huge Syncrude oil sands facility, which was reduced to just 20% capacity for all of September. This will likely be reversed in October as the facility returns to normal operations. So what are we seeing on the horizon? Well, bond markets tend to lead other financial markets, so let's check in with them. The German yield curve is negative now out to 7 years. It is widely expected that the European Central Bank will cut its deposit rate by a further 0.2%, which has short-term bond yields at a rate close to negative 0.5%. In other words, investors are paying to lend euros to the German government. They think that this is safer than holding cash. Not a great deal of confidence in the future value of the euro right at the moment in the short term. On the other hand, the U.S. short-term yields are suggesting a 70% chance of the Fed raising rates in December. This was actually closer to 80% earlier in the week, but the most recent economic data has shifted sentiment just a little bit. Meanwhile, less than robust economic news has pushed longer-term yields lower, and all the yield curves that we're looking at have flattened. Well, at the same time, bank lending rates are rising and credit conditions are tightening. As global defaults rise, while emerging market corporate debt globally has risen fivefold over the past decade, totaling $23.7 trillion in early 2015, according to the Institute of International Finance. Now, much of this increase has come from emerging Asia, where the non-financial corporate debt to GDP ratio has risen to 125%, which is up from 100% 5 years ago. Many, in turn, expect emerging market corporate defaults to rise further next year. Now, China's growth is slowing, and economies that have long been dependent on it are struggling, particularly as their currencies weaken. As I said before, borrowing costs are rising. Against the backdrop, companies and countries in emerging markets are due to repay almost $600 billion of debt maturing next year, according to the Institute of International Finance. $85 billion of this is denominated in U.S. dollars. Almost $300 billion of non-financial corporate debt will need to be refinanced next year. That's a lot. And as we have been saying, this is something that we're keeping a very close eye on, because, in fact, when we saw credit markets tighten significantly back in 2007, 2008, there was some very serious consequences. And at the moment, we don't think equity markets are taking this into consideration. So we're watching this very closely. There continues to be a wide divergence between high-yield bond prices and the S&P 500. Now, historically, high-yield bonds have led equities, but usually move quite far in advance of equity markets. So earlier this year, high yield began to turn lower, and equity markets followed in August. Now, since then, the S&P 500 has bounced higher. We haven't seen that kind of bounce from the high-yield market. So that divergence is something, of course, that concerns us. Well, we still remain convinced that equity markets are expensive, and certainly they've gotten more expensive today and over the course of the week. For the third quarter of 2015, companies are reporting year-over-year declines in both earnings, down 1.3%, and revenues down 3.9%. Now, analysts do not currently project earnings growth and revenue growth to return until the first quarter of 2016. In terms of earnings, analysts are currently predicting a decline of 4.2% in the fourth quarter, and in terms of revenues, analysts are currently projecting a decline of 2.9% in the fourth quarter. For all of 2015, analysts believe that earnings will decline by a little, close to 0.5%, and revenues down by about 3.5% year over year. Now, the price-earnings ratio of 16.4 for the index as a whole is well above the 10-year average forward 12-month price-earnings ratio of 14.2. Now, since the start of the fourth quarter, the price of the S&P 500 index has increased by 8.8%, while the forward 12-month earnings per share estimate has not changed. So something's out of whack there. We think that this is quite telling. In fact, profits at U.S. companies during the third quarter posted their largest annual decline since the recession. underscoring the competitive pressure from a strong dollar and weak global demand that could limit businesses' ability to support stronger economic growth in the coming months. A comprehensive measure of companies' profits across the U.S., earnings adjusted for inventory and depreciation, dropped to $2.1 trillion in the third quarter, down 1.1% from the second quarter. Compared with a year earlier, profits fell 4.7%, the biggest annual decline since the second quarter of 2009. That marked only the second time profits have fallen on a year-over-year basis since the recession ended in mid-2009. Well, in the other metric that we like to look at, enterprise value to earnings, S&P 500 companies are valued currently at a price of a little over 12.5 times. The 10-year average for that is about 10.8 times. In our tactical growth model, we don't really have much interest in anything that would be valued over 8.5 times. So, of course, we're looking for cheap value when we are making purchases for our clients and ourselves in our model, especially in the tactical growth model. Another indicator that we watch closely, margin debt, where investors and traders are borrowing to buy equities. It's been another indicator of the health of the stock market. In 2007, margin borrowing turned lower and was followed thereafter by the S&P 500. Now, margin debt turned lower in May. Again, this is something that makes us look forward with caution. And we're going to add another indicator to our list that points to the health of equity markets. It's called market breadth. And for those that don't know this, when a stock market is healthy, many companies are participating in the up move. When a market is less than healthy, fewer and fewer companies participate to the upside. So if we look at large companies in comparison to smaller companies, as we see in this chart, we can see that fewer companies are participating in the upside as that gap widens. In fact, very few companies are contributing to the upside of the S&P 500. Facebook, Apple, Netflix, and Google, which are commonly referred to as FANG, are responsible for the bulk of the upside movement. Yet one more reason for caution when it comes to equity market investing. So what does it all mean? Well, I suggested on BNN's The Close with Michael Hainsworth a couple of weeks back that I did not see a Santa Claus rally for equity markets based on many of the signals that we have been seeing. Weak economic activity, negative earnings growth, failing credit markets, and unhealthy market breadth, as well as a diverging monetary policy between the European Central Bank and the U.S. Federal Reserve. Now, I'm going to be back on the show on December 16th, which is also Fed Decision Day, where I may well have to eat my words if short-term markets bring more buying than selling heading into year end. So make sure you tune in to see if I have to talk my way out of a tight spot or not. Well, our discipline at all times is to protect our and our clients' capital, and especially so when we see the warning signs. We're not alone in this thinking. Cash and cash equivalents are important defensive assets, and we cannot stress this enough. So we are carrying greater than normal cash balances in our models and waiting for asset prices to get more reasonable price points before we commit capital for the long term. Well, what's up next? As I said earlier, it's a busy week, and there's no shortage of new information coming to us. Tomorrow we have Euro area inflation, as well as the Bank of Canada's interest rate decision. We're not expecting any moves there. That also will be followed later in the day by the U.S. Fed's Beige Book that they may use to determine what they intend to do in their interest rate decision in the middle of this month. So we'll be watching that and the results from that rather closely. On Thursday, very important decision on interest rates from the European Central Bank. On Friday, the always widely watched U.S. employment situation report, and also on the back of that, the Canadian Labor Force Survey. Next week, the Chinese balance of trade. Imports and exports have been watched very closely for indications of what's happening in the Chinese economy. And then on Tuesday, we'll see an update of the third quarter Euro area GDP, as well as what's happening in Chinese inflation. So again, lots of important indicators to come, and each time we see an indicator, it does influence how we perceive where and how markets or how we expect markets will trade going forward, and we are monitoring all these things very closely. Well, that's going to be it for today's discussion. If anyone might have a question, this is the time to ask. If you do have questions, please feel free to go.
Scott, do you think that
yes.
the markets have priced in the rate increase?
The U.S. Federal Reserve,
Yeah.
I would say somewhere between 70 and 80% would be the indication. Again, when the Fed raises rates, there will likely be some commentary, if and when they raise rates, there will likely be some commentary that follows in a press release, as well as a Q&A that Fed Chairwoman Janet Yellen will have. So markets will be monitoring those very closely, because what is going to happen next is really the key. If the U.S. economy doesn't improve with any significance over the course of the first half of 2016, then there's a very little likelihood the Fed's going to feel like they have to continue to push rates higher. So we'll try to get a feeling of how that all unfolds. But really what I would say markets are pretty much expecting that the Federal Reserve is going to raise rates. Now, at the same time, they're pretty much expecting that the European Central Bank is going to cut rates and add more stimulus. So there's lots of dynamics going on in the markets.
Hey, Scott, can you hear me?
Yes.
Oh, sorry, I'm not sure why I wasn't working. My audio wasn't working earlier, but if I could just add to Liz's question, part of the answer as well is our portfolios, the central banks, the Federal Reserve in the U.S., they really only raise and lower the overnight lending rate. That is the rate that they lend to money center banks. The rest of the yield curve and the bonds that we own some 5-year, 10-year, 30-year bonds. In fact, those bonds are rallying pretty significantly right now, i.e. going up in price. Today, in fact, more so than any other day. So Liz, just be aware that what the central banks do in the overnight market does not necessarily mean that rates or bonds, interest rates across the entire yield curve out to 30 years are necessarily going up. In fact, Scott and I believe that 10-year and 30-year bonds, the rates will actually continue to decline. And we could go into the reasons why it gets somewhat complicated on the term structure of interest rates and inflation expectations, et cetera. But that's been our call, and we've had that on for that position on for a while, and we will continue to have it on.
Okay, thank you.
All right, well, that's great. And if any of you who will be listening to this call when it is in the recorded version and you have questions, please, we always are happy to get questions and feedback on what you like or do not like about these calls each week. We certainly want to try to tailor them to the needs of our listeners. But that's it for another week. So thanks all for taking the time to tune in. Have a great rest of the week, a wonderful weekend, and we'll be back with another report next Tuesday. This is Scott Tomlinson signing off.